Happy holidays, everyone. There's not much that a group of 100 or so people can ever agree on. But the one thing I think we can all agree on today is today we are all tax people. My name is Peter Levy, and I am a partner at the law firm of Mandelbaum Barrett, a law firm that for nearly a century has unconditionally protected the interests of its clients and always put our clients in a position to succeed. It is my pleasure to welcome you to the 9th annual Tax, Trusts, and Estates Planning Forum, and we are really so proud to have you all with us here today. If it's true that the only things that are guaranteed in life are death and taxes, then I would argue it is equally true that for many of us, we strive for immortality by trying to secure a legacy, financial security, and a future for our loved ones who survive our deaths and frankly are not interested in paying our taxes. So with that in mind, and in the spirit of the families that we all have and love, I'm going to start with a family joke. 65-year-old man goes to the doctor. And the doctor says, "You are in remarkably good health. Blood pressure's low, cholesterol's good, heart's perfect. How old was your father when he passed away?" And he says, "Passed away? My father's 87 years old. He runs the family business, jogs every day." "That's great. You have great genes. It's really nice to hear. So how old was his father when he passed away?" "My grandfather? My grandfather's 108 years old. Jogs every day, life of the party, and he's getting married." So the doctor says to the man, "Let me get this right. Your 108-year-old grandfather is getting married?" He says, "Yeah." He goes, "Why is he doing that?" He says, "His mother's making him do it." If I can be serious for a moment, so much of what we do in our lives is based on the history, the context of where we grew up, the circumstances of our own individual eras. Those born in the Depression see money and savings very differently than a baby boomer or a millennial. With that in mind, with that context, today's December 7th. Is there anyone who wants to tell me the historical significance of December 7th? So, December 7th, 1941, the Japanese attacked the U.S. naval base at Pearl Harbor, killing more than 2,300 Americans. It's a date that is stamped on the hearts and the minds and the souls of an entire generation. And if I were to speak to my mother today, she will tell you exactly where she was, exactly what was going on. She can remember it like it was yesterday. Every generation has legacy events, and those put an imprint on how you see the world. So with that in mind, I'm going to just do a little informal survey here, and it's completely voluntary. Don't feel any obligation to raise your hand. But when you consider those generational events, how many people here can remember World War II? Okay, we've got a younger crowd. How many people here can remember the Cuban Missile Crisis? How many people here can say where they were the day that John F. Kennedy was assassinated? How about the assassination of Martin Luther King Jr.? The first moon landing. Can you remember where you were when the O.J. Simpson verdict was announced? Of course, 9/11, the death of Osama bin Laden. Each of us, depending on our ages, are shaped by our generation's collective memories. Each of us hope to control or shape our family's future through estate planning. Trusts and wills reflect the values and hopes we have for our generations. We try to control our family's wealth. There's an old Yiddish expression, and it says, man tracht und Gott lacht, which translates to, man plans and God laughs. And that, my friends, is why we need estate planning. So you're going to hear from some wonderful speakers this morning. My partners, I'm really, really proud of Steve Holt, Marty Houtman, Jason Marks, experts in their field. And after you hear their presentations this morning, we're going to open up the floor to Q&A. Now, these are very expensive gentlemen, and most of the time for them to opine and pontificate, the meter is running, it costs a lot of money. So as you're sipping your coffee and enjoying your breakfast, think about those tax questions, those issues that they raised here this morning that are of interest to you, and we will be going around the room and offering you a microphone if you'd like to ask a question to our esteemed panel. And I hope you will do so. Just a couple of housekeeping issues. If you are here to receive any type of continuing education credit, I want to remind you that you need to sign out. Even though you signed in, you must also sign out. And Stephen is going to be giving out a prize. So for those of you who filled out the little card, there will be a raffle for, is it luggage, Stephen, or bag?
To-me bag.
A to-me backpack, and it's really quite nice. The last thing I'll just ask you is, at the end of the program, you have an evaluation form in your packets of information. If you'd be kind enough to fill those out, you can leave them on the table, you can bring them to the front desk. We appreciate it. So with that, I am really honored to introduce my partner, Steve Holt. Steve chairs Mandelbaum Barrett's Tax Trusts and Estates Departments. Steve's expertise has helped protect so many businesses and so many clients and ensured their legacy and success. So with no further ado, Steve Holt.
Thank you, Peter. Good morning, everybody. Great turnout. We're really thrilled that everybody got out this morning. See a lot of friends and family here. It's great that we have that legacy with all of you. A lot of repeat attendees, which is really special for us. So thanks again for venturing out today. I wanted to thank our team, Lauren, Gabby, and Katie, for putting together the event today. They coordinated the venue, put together the materials, made sure you all were here and comfortable. So thank you, ladies. It's been really special, and we wouldn't have been able to do it without you. We have a couple of new partners to the firm that I thought everybody would like to meet. We added Sean McClelland to our Tax, Trust, and Estates Department earlier this year. Thrilled to have Sean. He comes with a great pedigree and a lot of experience, so he's going to really help us expand and grow the practice. We also added a very interesting and unique practice area this year, cannabis and psychedelics. And we have one of the country's leading experts as a proud partner of the firm. Josh, please. Bouchner. Josh has some fun parties, so we'll get you invited. Let me just see where we are here. So I'm going to introduce the agenda for a second. We have some really timely and interesting things to go over. Our objective is to give you insights on what's been happening, things that you need to be aware of as advisors and clients. A lot of what I'm going to be talking about kind of builds on some of the estate planning and transfer tax planning that we do. So I may bring up concepts that you're not fully familiar with, although I know most of you probably are. We will have a Q&A section, and you can ask anything about anything. But I think it's important for us to get the full agenda out to you. The comments that we've gotten in prior years were that we tried to cram too much into a small time frame. So we've expanded the presentation for about 15 minutes. But I think it's important that everybody sees all these things, and obviously the materials elaborate on everything we're going to talk about today. And if you have questions or concerns, please just call because we want to help you. So I'm going to talk a little bit about recent developments, legislative and IRS updates. Some really interesting things happened this year and are pending. Marty is going to then speak about the very scary and problematic and difficult Corporate Transparency Act. We spoke about that last year. It had just come out. There was a lot of confusion about it. There have been, I believe, 4 sets of regulations issued that are theoretically finalized. Scary stuff. Business owners are going to be panicking when we roll it out. We will be there together with your other advisors to help you get through it. Marty's also going to speak about the Secure Act. The Secure Act has been a work in process since 2015. There have been further developments in the area. The Secure Act covers, among other things, distributions from qualified plans, and you're going to need to know the latest, which keeps changing, by the way. We're going to then have about a 15-minute Q&A. Please save your questions for then so we can get through the material. Ask anything you want to, whether it pertains to what we're talking about today or anything that's on your mind, and we want to be available for you to take care of that. Lastly, we're going to have a panel discussion that's going to deal with tax and business issues in connection with a sale of a business, how that integrates with your estate planning, how we might be able to recommend ways to save income tax and certainly estate tax, or at least allow you to plan the transaction to get the best result for you at the lowest tax cost. We're going to end with some comments and then the raffle. I don't know if Katie's here. I hope she could show you the bag, but it's a very nice bag. We boasted until they were bought by Samsonite being general counsel of the Toomey brand for many years. And they're a great brand and it's a really nice product. Let me introduce my team. These are some of the best tax people you'll ever meet. We're also corporate lawyers, so we represent a lot of businesses and can do a lot more than just tax planning, but I think the benefit you get from our team is the ability to plan transactions for tax benefits. Marty Hoffman is a partner in the firm's Trust and Estates and Taxation Practice Groups. He also chairs our ERISA practice. Marty has been a leader in ERISA practice for over 45 years. He was one of the first practitioners, literally in the United States, to take up ERISA as a practice, and he's quite a well-renowned national expert in the area. He also focuses his practice on ERISA matters, pension planning, estate administration, business succession planning, and he's our preeminent advisor for IRS and state tax representation problems. Marty works in every state in the country trying to solve tax problems. He knows how to get through the system and have the right results for our client. He's also a CPA and a frequent lecturer to many trade associations. Jason Marks joined us a little less than 2 years ago. We were delighted that he chose us. Jason is also a partner in our firm's Trust and Estates Practice Group. He focuses his practice on taxation, estate planning and administration, elder law planning, life care planning, asset and wealth transfer planning, preservation, and special needs planning, which are really interesting nuances to the overall family estate planning program. Jason is a frequent lecturer before various trade associations. He also represents clients in tax controversy matters and is a member of the National Academy of Elder Law Attorneys. So I think you're going to enjoy hearing from these gentlemen. My job today is to kind of give you some updates on what's happening in the tax world. These are kind of the topics we're going to talk about. Oh, not working. Anybody? I think you have to plug in. There's Jason, nice picture. Mine was terrible, by the way, but what are you going to do about that? So I'm going to talk about a couple of things. recent developments in the tax area, a couple of very nuanced and interesting cases rather that you'll need to know about. Let me start with okay. So, as you all know, in the world of estate planning, Congress has given us a number of benefits so that most Americans, over 90% of Americans, will never pay an estate tax. That's not necessarily the case at the state level. The design of the current estate tax law as adopted in 2017 was to eliminate estate tax exposure to most Americans. The way they do that is by allowing you to make gifts to donees at a limited amount that have no impact on your gift and estate planning, and then also to make larger gifts within what's called your basic exclusion amount. The basic exclusion amount is an amount that you can transfer either during lifetime or at death without estate tax. It's a per spouse exemption. These are all adjusted for inflation, and given the inflation that we're having lately, which may be a silver lining to that, the exemption is going to go up by nearly $700,000 per spouse on January 1 to $13,610,000. It's expected that it'll go up another $500,000 per spouse in 2025. The generation skipping transfer tax exemption layers over the estate and gift tax exemption, and that's an exemption that you use if you want to make transfers to multiple generation trusts and have the trust not subject to tax at every generation level. It's a very important part of your planning. That is also going up to $13.6 million next year, and should be utilized in every case where there is a need for lifetime and then multiple generation planning. The gift tax annual exclusion is going up to $18,000 from $17,000. And the break bracket for taxation of trust for income tax purposes is going up from $14.4 thousand to $15,000. Congress has decided in its wisdom that people shouldn't accumulate income in trusts. So if you have taxable trusts, you are going to be taxed pretty much at the highest taxable rate, 37%, on every dollar of income in excess of about $15,000. That really justifies the trustee's interest in pushing that money out to the beneficiaries and having them taxed at the beneficiary's level. Sorry. So, all of this sounds great. All of us Americans are not worrying about estate tax. Well, guess what? Under the 2017 tax bill, this great exemption amount is expected to be reduced by half to about $7 million per spouse. That will subject many, many more Americans to an estate tax, and something we're watching very carefully. This is part of the sunset provision of the 2017 tax legislation. In fact, although that's the most impactful thing for us as estate planners, every component of the 2017 tax bill is going to sunset in 2026, January 1, 2026. That means the income tax rate goes back up to 39.6%. You get back your itemized deductions, and every other change which was perceived as favorable to taxpayers will be reversed. Congress has the ability to change that. We're watching that very carefully to see what in fact will happen in 2026. The lesson for you, though, is that if you're able to, you are able to make transfers during your lifetime using up your now $13 million exemption, and that will be grandfathered. So even if the sunset provision does take effect and the exemption is reduced to $7 million, you get to keep those extra gifts. It's something critically important to think about doing if you're able to. We have developed techniques that will allow you to make those transfers and still retain control and to some extent beneficial enjoyment of those assets. You have to do it carefully. It's not something that you can do without a lot of proper planning. So that's what's happening in terms of the estate tax law, some things to be wary of and to plan for. President Biden has once again introduced his tax proposals. There's nothing new there. These are proposals that have been bandied about a dozen times already since 2017. They are designed to basically gut all the planning we do. All the great lifetime planning that tax practitioners have developed, all of the tax savings techniques that are regularly employed have really been under attack by the administration. The last couple of times this was proposed, it didn't even get to the floor. We don't think it's going to go anywhere today, so this is sort of a political move. But I think you should know what the thinking is in Washington. And you know, anything can happen politically. We may end up with a very favorable Congress that likes these things. The Democratic Party is very anti-wealth transfer, tax-free, and all of these things are designed to eliminate all the benefits that we've been creating for our clients. The first, and it kind of dovetails with the Corporate Transparency Act a little bit, the first change that Biden proposed would be to require trusts with more than $300,000 in net assets or $10,000 of income to file reports disclosing the assets, the valuations, and information about the trustees. You know, trustees serve at the pleasure of the grantors of trust. They certainly don't want to be exposed to the government in that role. So that would be a serious problem for getting people to serve as trustees. The other thing that Biden proposed is to eliminate the present interest requirement for transfers to trusts. The present interest requirement basically says that if you make transfers to a trust, unless you give every beneficiary the right to withdraw a certain portion of the assets, then the transfer does not qualify for the gift tax annual exclusion. Many of us remember filing crummy letters. Most of our clients remember not doing them. I think they cut the power to us. Am I going too long? I'll talk faster. Get the hook ready. The Biden proposal would cap annual exclusions to $50,000 a year. So that means you could make gifts without reporting them and without using your exemption up to $50,000 a year. But think about it. If you had 10 beneficiaries, 5 kids, 5 grandchildren, today you could make annual exclusion gifts of $360,000 a year without using a penny of your exemption. So that's a pretty significant change in overall planning. The bill would also eliminate the benefit of GST planning and basically cap the period of tax-free treatment of a multi-generational trust or dynasty trust to basically 2 generations. Right now, if your name was Ford or Rockefeller, you've enjoyed this for decades, you can have trusts last for generation after generation after generation without incurring a penny of tax. The other part of our planning strategies that's under attack are the GRADs. A GRAD is a trust where you transfer assets to the trust, retain the right to receive an annuity for a certain number of years, and then the remainder passes to your beneficiaries tax-free. The way to structure a GRAT basically turns on 2 factors: how long it's going to last and what the annuity percentage is. If those numbers are correct and planned for, the value of the gift for gift tax reporting purposes is 0. That's called a 0 GRAT. Congress doesn't like that. They've been abused in their opinions. So they're proposing that the remainder interest of a GRAT, in other words, the gift component, has to be 25% of the value of the assets or $500,000. In addition, if the grantor exchanges assets with the GRAT, which is a very strategic opportunity to do at-death basis planning, those gains will now be recognized, whereas heretofore you could put assets in and out of a GRAT without incurring any tax. The minimum term of a GRAT will be 10 years. And again, this shows Congress's lack of interest in something that they actually created. GRATs are not something that we made up or we can't take credit for. They're in the code. There's a very clear set of regulations as to how you do them. There's no variation from those. So that's something we're watching. The next thing that Biden wants to attack is what's called the defined value clause. I don't know if any of you have had this experience, but if you have a hard to value asset and you're transferring it and you don't have time to get an appraisal or other reasons, you can actually create what's called a defined value clause. Basically, in my gifting document, I would say I give the number of shares of my company that has a value equal to my exemption amount. That's a valid gift under case law. Then when the value is ultimately determined and you're comfortable with it, you just determine the number of shares that were transferred based on the value clause. That would be banned. You couldn't use them at all. And the last thing that's sort of under attack is sale transactions between grantors and grantor trusts. If I set up a grantor trust, which is a disregarded entity for tax purposes, I can move assets in and out without incurring any tax, even though otherwise it would be a sale. The Biden proposal would want to tax those transactions. And lastly, the proposals would tax as a gift any payment of income taxes by the grantor on behalf of a grantor trust, which we normally plan for. So that's going to be a challenge going forward. I think we should get a discount for lack of electricity, by the way. I don't want to go too long. The next thing that I just want to bring to your attention has to do with reporting of gifts for gift tax purposes. Several years ago, the Internal Revenue Service created a set of rules and regulations as to how to report substantial gifts, how they should be valued, and what has to be in the gift tax return. The importance of that is that if you properly disclose a gift on a gift tax return, then the IRS only has 3 years to examine the return. And what they normally do in examining the return is attack the valuations, which we've been able to create strategies to make them relatively low. So it's important to run the statute of limitations. The quid pro quo for being able to do that is to adequately disclose the gift. In the Schlapfer case, I pronounced it correctly, which we view as a taxpayer victory, the IRS attacked a gift as not being adequately disclosed, relying on 5 factors that they rely on to determine whether the gift was fully disclosed. The court, smartly I think, said that the IRS's approach to strict compliance had to be relaxed and substantial compliance became the rule. So if you miss something inadvertently on a gift tax return, left off a beneficiary, maybe a date was incorrect, the IRS would say you're done, that doesn't work. Under this case, which I think is very important for people that file gift tax returns, you have a little wiggle room. We became aware recently of a case involving a decanting. A decanting is a process whereby a trustee, pursuant to power granted under the trust, can pour the assets, decant, into a new trust. So let's say your family situation changes and you don't like the terms of your irrevocable trust. This is a very popular technique. We do it all the time. New York actually has a decanting statute, so they give you a blueprint as to how to do it. New Jersey does not, and you have to rely on case law, which is relatively strict. New Jersey, however, allows for modifications of trust with the approval of the trustee and the beneficiaries. So an irrevocable trust is not an irrevocable trust. That's the bottom line. There are lots of ways to change it if you need to change it. Recently, the IRS attacked a case that involved a decanting. Basically what happened is the taxpayer decanted the trust into a trust that allowed for charitable gifts. The decedent who held that power under the trust transferred all of the assets to charities, thereby eliminating the estate tax. I believe it was a marital trust. The IRS said the decanting was flawed, and they did not allow the charitable deduction. Sorry. So in the Horowitz case, this was a docketed case, but it was settled, so there's no opinion. But a court order emphasized that a flaw in the decanting process cannot be considered, and that the taxpayer was allowed the charitable deduction. The point I'm making is that decantings appear to be under attack by the IRS. So I think you want to, when you're doing them, think very carefully about how you're doing them, comply with the statute, comply with the case law. The last thing is pretty scary. We don't know how to deal with it. This was the Conley case. The Conley case involved a buy-sell agreement and the valuation of shares of a company upon the death of one of the partners who were brothers. They screwed up in that they did not comply with the terms of the agreement, so the IRS was perfectly in its right to say that they did not have to respect the value that they set under the agreement as binding for estate tax purposes. In fact, the IRS does not have to respect a valuation of under a buy-sell agreement if the parties are related, unless the agreement is one that would be entered into by unrelated parties. That's called the comparability test. So they lost on that. They screwed up. They did not comply with the agreement. The IRS was able to foster its own valuation. The big problem was, though, that the buy-sell agreement was funded with life insurance. Everybody knows about that technique. The proceeds were paid to the company. The company, in turn, used the assets to redeem the shares of the deceased partner's estate. This case, which was in contravention of the Blunt case, which is a precedent that's been standing for decades, basically said that the life insurance proceeds increased the value of the company. So the value of the company was $3.5 million, for example, based on the IRS settlement. They added $3.5 million to the value. So not only did they not respect the number under the agreement, but they added in the life insurance proceeds. That is an anomaly. It was decided by the Eighth Circuit Court of Appeals, which is kind of right up the middle of the country. It's being, a petition for certiorari was filed with the Supreme Court. We think that'll be overturned. The Blunt case basically said that while there is a value accretion, there's also a corresponding liability to buy out the partner, and those offset each other, so there should be no increase in value by reason of the receipt of the proceeds. So this has been very scary for us. We're not sure how to do it. For the time being, if you have redemption agreements funded by insurance, you're really going to want to look at those for your clients and convert them to what are called cross-purchase agreements, where the other partner gets the insurance and buys out his partner. We don't know where this is going to go. So again, some tidbits. I didn't mean to rush through that, but I think these are things that we came to our attention. I think should be front of mind for you as well. In just a moment, I'm going to turn over the program to Marty to talk about the Corporate Transparency Act.
So I hope you're all thinking of the good questions you're going to ask Steve for the information and the dire warnings he's raising here. Before I introduce Marty, there are certain crossroads events that happen in your life. You have to buy a cemetery plot. You have to buy life insurance. You have to set up your will. These are difficult decisions, and the last thing you want to do is have an issue with your trust and estates attorney when you go in. This is something that never happens with Marty Houtman, but happened with one of our competitors.
Okay. All right. Hello, sir. Joel Reynolds?
You're Joel Reynolds?
Yes, I am. Would you like to have a seat, sir?
Yeah, and I'm a little puzzled. What's this outfit? Is it a Halloween party? What is it?
Oh,
does that mean?
That means we just dress like we would at home.
But you're not at home.
No, it's just casual Friday. So
Yeah, I know, and you told me that already. What do you do on casual Friday?
we just come in or work, but we dress casually.
I don't like it.
Well, it's just one day of the week.
I don't give a damn if it's half a day a week. I don't like it. I'm here to change my will. A lot of money is involved. It's very important to me.
Oh, we wouldn't treat you casually.
Then why the hell are you dressed that way?
It's just-
I want you to be on cutting edge, man, whenever you're handling my business.
This is cutting
I don't
edge.
need this crap. You look like a fucking cowboy. You're JR, huh? Joe Reynolds, right? You belong in Dallas, not LA.
I'm sorry, please.
Yeah, you should.
Just understand that we.
You should be sorry because you just lost my account. You go wrangle somebody else's. Thank you very much.
If you come back on a Monday or a Tuesday.
Ladies and gentlemen, an attorney who is knowledgeable and never casual, Mr. Marty Hauptman.
Thank you. I want to summarize Steve's presentation in one sentence. As one of my law school professors said, no man is safe as long as Congress is in session. Basically, we have the new CTA, Corporate Transparency Act. And again, there was an announcement November 30th that changed some of the filing deadlines for, I don't know, oh, this. No. Okay. What do I know about technology? So anyway, November 30th, they issued an announcement extending the filing requirements for 2024 new entities from 30-day filing to a 90-day filing of the beneficial owner information. So that's a major change. And then according to this news release, the FinCEN has provided the extension to give new reporting entities more time to become familiar with FinCEN's guidance and educational materials. And what they did was they published a small entity compliance guide in typical government fashion. It's only 56 pages. And if anybody wants a copy, I'm happy to email it to them if you leave me your information after the seminar. So what is the purpose of this Corporate Transparency Act? The Corporate Transparency Act is a new federal law that will impact owners, principals, and other control persons involved in all limited liability companies, corporations, C corporations, S corporations, limited partnerships, and closely held entities, as well as those who form companies. Congress originally enacted CTA in 2021 as part of the National Defense Authorization Act, and the principal purpose of this is to strip shell companies of their anonymity. The government is looking to pierce through layers of corporate shells to get at who the actual owners are of a business. And let's put this in perspective. Okay, Jason, Steve, and myself set up a new corporation to manufacture widgets. Because we own more than 25% each, we have to report our information, and I'll get to that in a few minutes. So basically, we become members that have to report. So we have to report our beneficial owner information to FinCEN. Now, FinCEN has a Form 114, which has not been released yet, which has to be filed electronically, which they haven't opened the portal yet, and this all starts January 1. This is the U.S. government. So basically, we have a filing requirement starting in what, 3 weeks? We don't have a form, we don't have the portal access. It's the government. What's the old line? I'm here from the government, I'm here to help you. So basically what this does is any business that falls under the category of a reporting, which is any small business The exceptions are regulated businesses, and there's 23 of them. I'm not going to go through them. It's banks, brokerage firms, insurance companies, things of that ilk. But if you have less than 20 employees and less than $5 million of annual revenue, you are a reporting entity. And you have to report who the beneficial owners are of the entity. And then what you have to do is, let's see if I do this right. No? Okay, forget it. What you have to do is you have to report information about each individual beneficial owner and each individual who has control. So going back to my situation, the three of us form our widget company. And we hire Peter. Where's Peter? Oh, he's taking a break. Good. We hire Peter as our president to run the company. He has control. He now becomes a reporting person. You can deal with that. And the question is this: who has to file, and what information do we have to give out? And basically, it's not a one-time reporting thing. It's an annual reporting thing. So if any of the basic information changes, we have to report it. So now, Steve's a smart guy. He says, I want to get out of New Jersey. I'm going to Florida. I don't want to pay any taxes. That's a change of address. That becomes a reporting event. So basically, the company has to report that Steve, as a beneficial owner, has now moved from New Jersey to Florida. So it's a constant, ongoing thing. And the purpose of the CTA is to create a national database of companies and entities and individuals who control assets and wealth. And we have to disclose a lot of information. We have to give the full name, no initials, an address, and it can't be a P.O. box, it can't be the lawyer's office, can't be a registered agent's office, it's got to be your home address. You've got to file with a copy of your driver's license, passport, you need date of birth information, and any time that changes, you have to report. So like I said, if Steve moves to Florida, he's got to refile. If you change your name, you have to refile. So this is an ongoing reporting requirement. And basically, it affects any small business, whether it's a professional practice, dentists, lawyers, accountants, financial advisors. If they're under 20 employees, under $5 million in revenue, they're reporting. Anybody who has more than 25% is automatically a reporting person. Anybody who has any kind of control over the business, if, like I said, we appoint Peter as our president, and Peter has the authority to control the business, he becomes a reporting person. And it gets more complicated when we get into areas of trusts. Okay, if we set up a trust, and I put my vacation home in the trust for liability purposes, it has no revenue, but just an LLC for liability purposes, by definition, that becomes a reporting entity. And I now have to report the owners of the LLC, my wife and myself, and I have to give all of that information. And if we move, we have to give all of that information again to FinCEN. Now, there is a way around this possibility, is each individual can get what's called a FinCEN identification number. And basically what that means is you apply to FinCEN, you give them all of the required information, name, address, government document, date of birth, social security number, and they will give you an individual FinCEN number. It's going to be like a social security number. And what happens is if Steve changes his address and he's registered with FinCEN, he doesn't have to disclose that to the reporting entity as long as he keeps FinCEN updated with his changes. So if Steve is not only a member of our little widget company, but he's a trustee of 22 trusts that he set up for his clients, under the rules, he would have to report on each of those 22 trusts. If he's a member in FinCEN, he's registered, he only has to notify FinCEN once. So that's something that has to be dealt with. The other issue we've got is the reporting. And once they report, it's a continual reporting. Every time there's a change in what happens. Now, if you have a trust, I mentioned trusts. All right, Steve set up, he's a trustee of 20 trusts for his clients. If he has the ability to control the disposition of assets under the terms of the trust, he becomes a reporting person. Not only do you have to disclose the reporting person as the control of the trust, you have to report the name of the individual beneficiary of the trust. So if Steve is the trustee of Jason's Children's Trust and Jason's children are emancipated, we have to give him that information. If Jason has a minor child, you don't have to disclose the minor child's information, but you have to disclose the parent's information. And once the child reaches the age of majority, you then have to register the child, who's now an emancipated person, with FinCEN and disclose all of that information. So the question is, a lot of trusts that are set up for estate planning purposes, for liability protection, asset protection, where there is a trustee who is in control of the assets, that becomes a reporting entity. If there is a trust that's set up that owns an underlying business entity, that becomes a reporting requirement. Jason and I were recently involved in a case where there is a trustee of trusts, which they had a number of investment entities controlled by the trust, and basically those trustees become reporting entities. They have to register with FinCEN, provide all of their information, name, address, date of birth, and you have to upload a document of registration, like a passport, driver's license, things like that. For new companies filed after January 1, 2024, the filing requirement is 90 days, and it's only for entities formed in 2024. After 2024, it goes back to the original 30 days. For entities formed prior to January 1, 2024, the filing requirement is by the end of 2025. So think about every corporation, LLC, trust that you've set up that has assets, has people who control the assets. All of those entities must report by December 31 of 2024. Okay, it's a massive undertaking. FinCEN estimates that there are going to be 32 million entities that have to file by the end of 2024. So again, we've really got a small window to address all of these, and some of these are not going to be simple things to deal with. If you've got multi-layers of corporations, you've got parent corporations with subsidiaries, you have different shareholders, and basically it's not only the owners, like the example I gave you, the three of us, but if you have somebody who is in control of the day-to-day operations, that person is also a reporting person under FinCEN's definition, not FINRA, excuse me. So basically, you've got to analyze every business entity, every trust, to make sure you're in compliance, because there are significant penalties. The penalties can run up to $10,000. There is a criminal component. They can send you to jail. Not a nice class of people. And basically, you have to look at who owns and controls the underlying assets. So again, when we have multiple layers of trust, when we set up trust for asset protection, and you have a trust protector, if the trust protector has authority to control those assets, that trust protector becomes a reporting person. So again, there's going to be a lot of people that have to report. Now, if you're setting up a company, it's called a company applicant, whoever files for the company has to report. So if I set up a new corporation next year, I have to report my name, my address, my social security number, and I have to upload a copy of my driver's license or my passport. If I have a paralegal or an assistant in my office who does it, she or he is responsible for providing that information. The reporting company information only applies to companies set up next year going forward. You have to disclose the reporting person's name and those people who control. So if I say to my assistant, set up an LLC for Steve and Jason, and it's under my direction, we both have to report. You don't have to report more than 2 people, okay? So again, this becomes a huge reporting obligation. And it's something that if you're going to be setting up LLCs for estate planning purposes, you take a piece of property, put it into an LLC for liability protection. Whoever files that LLC now becomes a reporting person and has to disclose all of that information and get involved with the refilings. Now, again, one of the exceptions is if you're going to be a company filer, you can apply for and get this FinCEN number. So instead of giving all of my personal information every time I file, I can say my FinCEN number is 1234, and that supersedes it. But every time I move, if I change my name, if I get a new driver's license in a different state, I have to update that with FinCEN every time that is done. And there are civil and criminal penalties for failing to comply with the FinCEN regulations. And again, equity is not only ownership. They've ruled that if you have a convertible debt, that's includable. So again, we set up our widget company, and we offered Peter a job. Peter, we're going to hire you. You're going to be the president, and we're going to give you an option to get 25% of the company if you hit certain benchmarks. Because that has an equity component, Peter now becomes a reporting person. So again, anytime you've got, even debt that's convertible is deemed to be an ownership interest, whether or not it's ever exercised. If that person has the right to exercise that option to convert debt to equity, that has to be reported. So again, you've got to go through every company, look at your debt structure, your capital structure, and see if you've got anything that can be converted into an ownership interest, because all of those people are now subject to reporting. Again, if you have a board of directors, if the board of directors have a right to remove an officer, that can, in certain situations, give them control of assets. So again, before you accept a position as a board of director member of a new company, oh, okay, they're telling me to go to the next topic.
In 5.
Thank you. All right. Okay. Going on to the Secure Act. Sorry about that, guys.
Right on time.
Right on time, all right. Gabby's keeping me under control here. Again, like I said, the Secure Act is really dangerous. All right, I'll stop there. Let's talk about secure. It is, because you've got to disclose everything about you. Name, address, and you can't use initials. Like my idol, D.B. Cooper, can't use D.B. Cooper. Okay, monumental event. Anybody know who D.B. Cooper is? There we go. Right, he jumped out of the 727, right. Okay. So anyway, you couldn't use D.B. Cooper. You'd have to use his full name. All right, so let's talk about Secure Act. One important change that came...
He won't have to report it.
I'm sorry?
He won't have to report it. He never turned out.
Well, okay. And it was a cash transaction, so who cares? All right, Secure Act. Let's talk about a little pension stuff. There was, under one of the significant changes of Secure Act was the requirement that anybody who had more than $145,000 of income could not make a catch-up contribution. It had to be a Roth contribution. Everybody who was involved with pensions was complaining about that. Put this down here. So what the IRS in notice 2023-62 said, okay guys, we'll give you a break. So the catch-up rules don't take effect until 2026. So what that means is if you're over 50 and you make the catch-up contribution, you can still make it into a regular 401k plan for the next 2 years. Starting in 2026, if your income is over $145,000, the matching contribution, I'm sorry, the catch-up contribution must go into a Roth account. I don't understand the logic of requiring that one, but again, I don't write the law, I just read the law. I'm just going to hit a couple of the high points of the Secure Act. Under Section 108, under the old rule, you had for IRAs, you had a $1,000 catch-up contribution. The new rule for years beginning January 1, 2024, that catch-up is indexed for inflation. Section 110, employer matching contributions for student loan payments. Under the old rule, employers' contributions to defined contribution plans on behalf of employees made with respect to student loan payments are not treated as employer matching contributions. Under the new rule, employers can make matching contributions under a 401k, 403b plan, etc., as a matching contribution, and that's for a qualified student loan payment. The recipient has to self-certify to the employer that the payments are made to a qualified student loan. The plan has to have language that provides for matching contributions on account of qualified student loan payments. Under the plan, all eligible employees eligible to receive matching contributions have to receive them. And we'll move on, let's see. Section 115, no early withdrawal penalty on something called an emergency personal expenses. Under the old law, no provision that specifically exempts emergency withdrawals from the 10% withdrawal penalty. Under the new law, the 10% early withdrawal penalty does not apply. It's a once a year provision. The limit is $1,000. And if the distribution is repaid within 3 years, it's reversed. And during the 3-year period, you can't take any other additional withdrawals. There was one significant change which I want to find here. Oh, here. This one is really important, and I don't even know the rationale behind it, but if you've got a 529 plan, qualified tuition plan, you have the ability to now roll that over to a Roth. Okay, so what that means is if you've got a distribution from a qualified tuition plan of a designated beneficiary that has been maintained for a 15-year period, the distribution can be rolled over to a Roth account. Okay, the limit on that is $6,000 a year, the regular Roth contribution limit, and there's a lifetime aggregate of $35,000. So what that means is if you've got an old 529 plan that nobody's claimed any benefits under, you have the ability to convert it to a Roth so that the designated beneficiary can defer that for the balance of his or her lifetime. And that's probably one of the more significant changes to the Secure Act 2. Again, you can only do this for up to $6,000 a year. So with the $35,000 cap, it'll probably take about 5 or 6 years to absorb whatever you've got in the account. Another thing is starter 401k plans is something new. The government is trying to encourage savings. So what they're doing is they're waiving the non-discrimination testing, ADP, for certain startup 401k plans. The government is also encouraging qualified plans by giving a credit for the payment of the cost of qualified plans. The deduction is up to $1,000 for small plans, so that the idea is this can offset costs of setting up and establishing and testing new 401k plans. Again, the government wants to encourage companies to set up retirement plans for their employees. And let me just mention one thing is a number of states have set up mandatory state requirements. If you have a small company and you don't have a qualified plan for the company, there are state pools. New Jersey is a state that has it, that you have to participate. You have to set up a benefit plan for your employees. I'm always leery of state-run plans, but it's something that's going to be coming in the next year. So if you have small business clients, something to take a look at. Okay, the last thing I want to touch on is the IRS has a self-correction procedure for inadvertent plan failures. And basically the IRS, under Secure Act 2, has expanded the types of failures that qualify for self-correction. The self-correction has to be completed within a reasonable period of time, which is deemed to be 18 months from the discovery. It cannot involve the misuse or diversion of plan assets. It's not directly related to a tax avoidance transaction. And the company has to establish procedures to make sure that the failure doesn't happen again. It does not apply to certain classifications, like the failure to adopt a written plan, significant failures and termination of plans, demographic failures, and operational failures. And then to comply with that, the IRS has extended the remedial amendment period for certain of these amendments from the end of the calendar year to the due date of the tax return, including extensions. All right, did I make it? All right, thank you.
So there are some people, some families in this world that don't have the luxury, the opportunity of working with fine financial people like all of you, or to get the estate planning expertise of Jason Marks. This is how families who don't use our services handle their retirement planning.
Could you get it, Daddy?
Just come back.
Should we have another one?
Talk to us about retirement today. Feel comfortable about tomorrow. Mass Mutual.
So I'm going to introduce my partner, Mr. Jason Marks. He is going to lead. I hope you have some good questions you'd like to share, and then Jason and the rest of the esteemed panel have some other topics they'd like to raise with you. So I'll turn it over to Mr. Jason Marks.
So just to be clear, this is the time for questions, anybody?
Does the Transparency Act apply to nonprofit entities, 501c3s, 6s, etc., that are formed as corporations?
I don't think so, no. No, I would say no.
You know, the purpose is to flesh out people hiding assets or used for terrorists and other purposes. I don't believe it's reached that far. Maybe should. Anybody else?
Good morning. Marty, question to you on the 529, if you have a surplus and you roll it into that Roth, which came out in January. What happens if, let's say, your third kid, the other two adults are working, your last kid has 30 grand left over or 50 grand, and you want to also put that Roth into the other kids. You're the owner, possibly their 529s are depleted. How do you then get it to the other two kids if you want to divide them into a third?
It says the designated beneficiary, so it would be whoever the designated beneficiary of that Roth account is. So the child number 3 is the only one that gets it.
Hey, Phil.
Thank you. Looks like the CTA is an item. And aside from the governance issue, what they're going to do is data dump when they finally get the system working. Does it apply to disregarded entities?
I'm sorry,
Does the CTA, apply to disregarded entities, say like a grant of trust and a sole LLC, or is it only for the ones that actually have a tax entity, taxable entity?
If it owns any assets, it becomes a reporting entity. So the trustee would have to report it.
Even though a grant of trust is considered disregarded?
Yes.
It's not part of a tax provision.
Right, and even if you had a
Part of the
schedule,
FinCEN regulation.
even if you had Schedule C, and basically, and you had assets in that Schedule C, you would have to get the registration and FinCEN number.
One more question about the CTA. You mentioned that people who have control of an entity need to report, and you keep mentioning the president. What other guidelines establish control? Is it simply a title, or does it have to do with what they sign?
Basically, anyone who has control over the assets or operation of the business. Okay, I was trying to simplify it when I said president, but if you have any corporate officer or anybody with authority to control or move assets, that person becomes a reporting person. And there's no limit to the number of people who have to report. So if you have, let's say, 20 people, let's say divisional vice presidents who control their division, they become reporting people. I said CPA is scary.
Another question about the CTA. What is the measurement date for number of employees or amount of assets to become a reporting entity? And what happens if you go above the threshold, let's say, the following year? When do you age out of the requirement if you grow beyond that threshold?
In theory, subject to final regulations, once your entity passes more than 20 people and more than $5 million of gross revenue, you're then no longer a reporting company.
Thank you all. This has been a great ride so far. I've so far only heard firms say they will not be responsible for filing the CTA. Do you have any understanding of who is going to ultimately be responsible for filing?
We want the accountants to do it. Or you. The responsibility falls on the company, obviously. I mean, as advisors to companies, if they expect, as part of what your service platform is, to deliver compliance programs, you may in fact be in the forefront of that. It's going to be complicated, so our clients are going to be looking for us for guidance, but it's not our responsibility unless we form the company. So, all of the accountants in the firm, in the room, and certainly the attorneys form companies every day. It's a matter of convenience. Our paralegals form companies. They all are going to be reporting parties. So we're in it no matter what, but there's no responsibility, Barbara, on any professional's part to do anything.
One thing that you have to keep in mind is amending bylaws and operating agreements to require members to disclose the information that's necessary for the entity to report. Because again, you have to get name, address, copy of your passport, copy of your driver's license, all of that has to be disclosed. And I think going forward, we have to add a clause in our operating agreements and partnership agreements and things like that to require members, stockholders, whatever, to disclose that information.
You know, one thing I don't know if Marty mentioned, and I think it's important when you really look at the CTA, this information is going to be available to every law enforcement agency in the country, the Secret Service, the FBI, the CIA, certain financial institutions. You know, in this era of everybody trying to protect their personal data, if you look at the list in the outline, it's everything that you're worried about protecting. And, you know, we have to think about, you know, when is that site going to get hacked? There's going to be scores of millions of people reporting their social security numbers, their dates of birth, their full names, their addresses. I don't think that FinCEN and the authors of this really thought about that. So, you know, you need to really focus on where this information is going and you know, maybe think about the impact to your clients and make them understand that. It's a you know, a big brother scenario, it really is.
The bigger government's so trustworthy.
Yes. and safe.
Hi, good morning. Thanks again for the program. Marty, is there, as far as you know, is there a hard date as to when the state mandated retirement plans?
In New Jersey, I believe it's next year. I'm not 100% certain, but I believe it's next year in New Jersey.
I'm sorry, I was interrupted. Could you say that again, please? Was there a date?
I believe it's next year in New Jersey, 2024.
Right, okay. Can you comment on the Moore versus USA Supreme Court case about taxing unrealized gains?
Moore is a case where they're challenging the repatriation tax. And the question is, does the tax of a foreign entity or profits of a foreign entity raise to the level of an income tax under the Constitution? And I think it's a valid challenge because there was no actual income in that case. What there was basically an accumulation of income in the foreign entity and no distribution to the U.S. taxpayer. So basically the taxpayer was forced to pay tax on income that was earned overseas and never repatriated to the U.S. So I think it's a valid challenge. But the problem you have is, based on the split of the Supreme Court, you have without getting too political here, a conservative approach, and they may reject it. Just an opinion.
Does that mean we could ultimately all get taxed on
Yes, if that means that ultimately they'll be taxed on unrealized gains.
Well, you know, you have states that want to tax unrealized gains. Washington the state of Washington has proposed a tax on unrealized gains. And that, I think, is clearly unconstitutional. But what do I know?
Anyone else? Thank you. Yes, go ahead.
I'm just curious, do you have any comments? Are you representing any clients in this ERTC claims and whether or not they're using any of these mills and any exposures they may have?
A few cases have come to our attention. We referred them to you. ERTC help, Steve is an expert. So far, no. In fact, what we've noticed is most of our clients are being told at a very surface level that they don't qualify because they don't look at the alternate opportunities. They just look at the numbers test, which is pretty simple to run internally. The controller can do that. So not a lot of that has come up to our attention. Anyone else? Well, those are great questions. Thank you. We can hang around afterwards if anyone wants to stay one-on-one. I'm thrilled to introduce my partner, Jason Marks, to talk about business sales, traps of the unwary, what you need to know, what you need to plan for, and what opportunities are available. We're going to do this as a panel, so Jason's going to take the lead on that. Thank you, Jason.
Thanks, Steve. Can you hear me? All right. So last year, for those of you who attended, we conducted a panel discussion a lot like this one. The topic of that discussion was business succession planning and the use and importance of buy-sell agreements. Steve already talked about the importance of buy-sell agreements. One of the topics and one of the things that we addressed in that discussion last year was various types of succession plans, and one of which involved the sale of the business. Sales can take place between family members. They can take place between third-party, unrelated individuals. But most importantly, there are a number of issues that come up when we talk about a sale of a business. Most importantly, taxation. So fitting for this discussion, probably the most important issue, again, is taxation. And at the end of the day, sellers are really concerned about what are they going to walk away with after closing? How much are they going to keep? Relevant to that discussion are the income taxes that a seller is going to have to recognize on the gain, and also our estate tax issues. So with that, welcome to our panel discussion about sale of the closely held business and the intersection of estate and income taxes and the techniques used to minimize and avoid taxation. So again, when we talk about selling a business, one of the things that I want to do is just sort of tee up some key considerations going forward when addressing a sale of a business, and then involve Steve and Marty on more of the esoteric planning considerations and tax considerations. So as a background, a lot of times when a party is considering selling a business, they might consider changing the organizational structure of the business. They'll be concerned about whether or not the business is going to be sold, whether it's going to be passed on to the next generation. So there are basically 4 income tax considerations that clients need to deal with right off the bat. The first is, what kind of business is involved in the sale? How is the business classified for income tax purposes? Who are the current owners? And really, what does the seller want to have happen at the end of the day? Is the seller in good health? Is he going to live for many years after this? Is he not? And is there a likelihood that he might pass within a reasonably short period of time after coming to the decision that he might want to sell the business? In the United States, there are essentially 5 different types of business types. They include corporations. These include professional corporations and associations. There are general partnerships, which include unincorporated associations and limited liability partnerships, limited partnerships, limited liability companies, and sole proprietorships. Now, knowing how a business is formed doesn't necessarily tell us what the tax considerations are as it relates and how it's treated. Corporations are taxed under subchapter C of Chapter 1 of the Internal Revenue Code, unless they make an election to be treated as a subchapter S corp, in which case they're treated under subchapter S of Chapter 1. C corporations are tax-paying entities, just like individuals. They report their gain, they report their income to the IRS each year, and they pay tax on the net income. They don't get to deduct dividends paid to the shareholders. But in turn, their shareholders, when distributions are made as dividends, shareholders then have to report the dividends. I'm sure I'm telling most of you things that you already know, but just for background, I think it's helpful. S corporations, on the other hand, are tax reporting entities. They report their incomes and gains to the IRS and to their owners, issue K-1 to their shareholders, and the shareholders report the pass-through income on their individual income tax returns. Likewise, partnerships, both general and limited partnerships, which are classified as partnerships, are tax reporting entities like the S corporation. They report their income to the IRS and to the, They report their income to the IRS and to the owners, who then report the pass-through on their individual income tax returns. Limited liability are a little bit different. What happened here? Okay. An LLC has some flexibility in how it's going to be taxified for tax purposes. A single-member LLC is a disregarded entity. It essentially doesn't exist for income tax purposes. It's treated as a sole proprietor, where the default, if there are two or more owners, the default classification is a partnership. Now that is unless the LLC owners decide to check the box and choose to be treated as a corporation for income tax purposes. Sole proprietorships, probably the most popular, most common form of business entity, simplest to form. You really don't have to do anything. You just start and operate a business. Most businesses start from scratch, and the owner just runs the operation and reports their income on their Schedule C. It's taxed just like a single-member LLC, and its revenue deductions are reported by the individual owner. So the next important issue is identifying who the owners are, because as I mentioned before, many times businesses might change its form of structure. So knowing who the owner is going to determine planning choices. It may also determine whether or not the business is going to be remaining in the family, or if it might pass out to outside third parties. So before we get into the next slide and the next discussion, I want to ask Steve and Marty, what are the differences from an income tax perspective between an asset sale and a stock sale? And how does the income tax classification of the selling entity affect the outcome?
Thanks, Jason. So obviously the C corporation is the target company, and the assets are sold, which is normally what buyers are looking for. The corporation is going to be taxed on the gains on all of its assets. Presumably most of that is a sale of goodwill. Corporations don't have capital gain level taxation, so it's basically all a 21% tax. And then when the remainder of the proceeds are distributed out to the owners, they're going to be taxed again. For that reason, most C corporations seek to structure a sale of the equity of the company, thereby allowing the owners to recognize only a capital gain on the sale. A hard trick to pull off because buyers don't want to walk into the liabilities built into that company, and that's a risk from the buyer's perspective. With S corporations and limited partnerships, limited liability companies, it really doesn't matter. The tax result is the same, whether the assets are sold or the equity is sold. So the considerations there tend to be more on risk mitigation and risk management from the business owner's perspective.
Thank you. Marty, is there anything you want to?
Yeah.
Sure.
One of the things that one of the things that a purchaser wants to do is get a step up in basis for the hard assets it's buying. So therefore, that's why you may want to buy the assets versus the stock of the corporation. As an example, if you've got a truck that you bought for $100,000 and it's depreciated down to $20,000, but it has a fair market value of $50,000. If I'm buying the assets, I get no step up in basis. If I buy the actual asset, I can step it up to the fair market value. In the LLC, you can make what's called the 754 election to step up the assets. And then in the corporation, you also have the ability to make what's called the 338H10 election, which will allow the buyer's entity to step up the basis, but the selling entity has to pay the tax on the difference between the book value and the fair market value.
So let's talk a little bit more about sales of corporations, starting with the C corporation. The use of C corporations had actually decreased for a while, but as a result of the 2017 Tax Cuts and Jobs Act, we've seen a resurgence in the use of C corporations as operating entities. And getting again into a little more detail on what Steve and Marty were talking about, we're talking about sale of assets of a C corporation. One of the most significant tax issues for the seller is the issue of double taxation. And this occurs, when the assets are purchased. The gain on the sale of assets is taxed both at the federal and at the state level. The corporation is going to recognize that gain and report the tax. When the distributions are made from the corporations to the shareholder, again, the shareholder is going to be taxed again. So as a result, the double taxation can cause a total tax on the transaction to exceed about 50%. Conversely, on the selling of C corporation stock, the seller of the C corporation stock will pay capital gain on the sale of the stock, which will most likely qualify for the long-term capital gain rate of 20%. Depending upon the seller's level of involvement with the business, they may also be subject to the 3.8% investment income tax on net investment income. And depending upon where the shareholder lives, they could also be subject to state income tax. So various considerations to take into account when selling a corporation stock is the different levels of taxation that a seller may have to face. On the other side, selling S corporation stock, the seller is going to recognize gain again on the sale, the difference between the purchase price and the adjusted basis. With S corporations, and Steve, Marty, you maybe want to address what the adjusted basis and how that's determined with S corporations.
Sure. So the adjusted basis obviously starts at the shareholder's investment in the company. It's increased by income that's not distributed, and it's reduced by income that is distributed. Companies that pay a lot of debt service or otherwise accumulate income will find the basis arising. They'll take out about as much money as the owners need, and the basis continues to be increased based on the amount of money that's accumulated in the business or paid out as non-deductible expenses. That's the simple formula. There's nuance to that, but essentially that's something that a business owner has to pay attention to. In the C corporation, your basis is what you pay for your stock, period. Doesn't change. And in S, you have the opportunity to grow the basis, thereby reducing the gain on an ultimate sale. That's the same with an LLC or any entity taxed as a partnership.
Thank you. When we talk about selling S-Corp assets, again, the seller is going to have ordinary income and capital gain passed through to them, and the corporation is dictated by the purchase price allocation of the purchase agreement. Ordinary income will be taxed at the seller's marginal tax rate. Capital gains on certain of the assets are going to be taxed at the capital gain rate. Steve, Marty, perhaps you can address the allocation of income on the sale of assets and how that's typically structured.
There are certain assets that carry over like cash. There's no step up in basis. It is what it is. And then you have your other class of assets, like for instance hard assets, equipment, machinery, things like that. There's a basis is the book value. And then you have intangibles, like trademarks, goodwill, things like that. Those are all capital gain assets. The purchaser of a capital gain asset, like a trade name or goodwill, can write off the amortization over 15 years under Section 197. So again, the classification of assets will determine the depreciation type and basis.
Thank you, Marty. Now, question for both of you. What factors should sellers consider when deciding to engage in a stock sale or an asset sale, assuming that the decision is theirs? And what are the advantages and disadvantages? And if you can, please also address the built-in gains tax risk that applies to S-Corp sellers.
All right, let's take them in reverse order. Built-in gain of S-Corps. If you are an S-Corp and a C-Corp and you convert to an S-Corp and it's less than 5 years, you have what's called built-in gain. You have to pay tax on the gain of the assets that would have been on the date you converted from a C-Corp to an S-Corp. And what was the rest of the question?
What factors should sellers consider in deciding to engage in either a stock or an asset sale?
Again, a stock sale is clean and easy. I sell you my stock. It's just like if I sell my stock in Apple. I sell it to you. The gain is computed by what I paid for my stock versus what I got it for. It's clean, it's simple. When we get into an asset sale, you've got to parse through the gain on individual assets. And then what happens is the overall gain is reported at the entity level, corporation, S-Corp, C-Corp, LLC. I turned it off. And there may be issues with that. Anything you can think of now?
If you do a stock sale, which as Marty said is easy and the tax result is predictable, it comes with some baggage in that the buyer, if they're even willing to do it, will expect that the selling owners will indemnify them for claims. They now own the company, so their indemnity can't apply to the business. And you get a lot of issues with sellers continuing to have to be personally liable for some period of time, whereas in an asset sale, normally they'll look to the company only, and that somewhat mitigates the risk of the owners. So, it's something that they have to have an appetite for. Normally, look-backs for indemnity claims are relatively short periods, maybe 1 to 3 years, but it imposes risk. In addition, the buyers look for much larger holdbacks to cover their liability because they haven't been able to identify precisely what liabilities they're assuming. So you have some business issues you have to look at. So the tax efficiency and the ease of completing the deal is maybe not worth the substantial risk that the sellers have to undertake going forward.
Okay, thank you. Another question for both of you. Now that we've talked about stock sales and asset sales, the risks, the issues that are involved, what are some of the ways that sellers can structure an asset sale to minimize income or gain, and does it matter if the selling entity is a C or an S Corp or partnership?
So one technique we use, and I'm sure there are many, is something called an AIM trust. And that stands for Incomplete Non-Grantor Trust. You can only set up an AIM trust in jurisdictions that have creditor protection statutes. There are 17 jurisdictions. Most notable are Delaware, Alaska, Nevada, Wyoming, and South Dakota. And it's very complicated why this works, but if you do establish a trust in one of those jurisdictions and the trust owns the shares of your company, that trust will not be treated as a trust constituted under the state in which you're a resident. New Jersey's a little tough to do this. In California, you can't do it at all. New York, you can't do it at all because they've legislated against it. But if you're a New Jersey business owner and you have no New Jersey source income and no Jersey cited assets, and you set up a trust with a non-New Jersey trustee, upon the sale of the business, you can completely avoid, not defer, completely avoid the state income tax, which on big transactions is north of 11% now. So it's very worthwhile doing this planning. It works even if you have New Jersey source income, if you're a C corporation. It does not work if it's an S corporation or limited liability company. So there are some great strategies to save the state income tax. The federal tax you pay, the best you can do with the federal tax, at least from my experience, is to defer it potentially through installment sales. And obviously structuring the deal so that all of the gain is capital gain and very little ordinary income.
Oh, yes, but I've got a way to pay no tax.
We'll get to that.
Move to the Cayman Islands.
No, cheap.
Oh, it's up there.
Okay, so we've talked about the income tax. Let's see how, sale of business, as I said before, there are income tax considerations and there are estate tax considerations. One of the biggest considerations, at least in this case, for tax minimizations is dealing with the cost and the basis of the assets that are being sold. And from the estate tax side, the consideration is Section 1014 of the code, which states, and I'll just read this to you, but we've all heard about the step-up basis. Section 1014 says, except as otherwise provided in this section, basis of the property in the hands of a person acquiring a property from a decedent, somebody who inherits, or to whom the property passed from a decedent shall, if not sold, exchanged, or otherwise disposed of before the decedent's death, be the fair market value of the property as of the date of the decedent's death. That's what we refer to all the time as the basis step-up when somebody dies. So if you own 100 shares of IBM stock, you pay $10 for it. You die when it's worth $100. Your heirs, your beneficiaries, will take the stock at $100 basis, so that if they turn around and sell the stock at $110, they're only going to recognize $10 of gain, whereas if the original seller were to have sold it prior to death at $100, would have recognized $90 in gain. So when we talk about the sale of the business now, this is where it becomes an important consideration. Do we hold it or do we fold it? Now, this Venn diagram really depicts the interplay of the transfer tax, which includes estate and gift taxes, versus income tax. Transfer tax, a gift tax, the basis transfers over from the donor to the donee. Income tax, you get a basis step up when an asset is sold, or you're going to recognize the income between the difference of the fair market value and the amount of the basis that the seller has in the property that is being sold. So, big consideration when we do estate planning, when we talk to our clients who are business owners, is what do you want to do? What's more important to you? And sometimes it's not necessarily a financial decision, it's not necessarily a tax decision, but there are more personal issues that are involved in making the decision whether or not to hold on to the business, sell it, or pass it on to the next generation during lifetime, or wait until after death. So the old thinking, now I'm going to take you back, this goes back to early 2000s, before the 2011 Act. The old school type of thinking was, when in doubt, transfer it out. Pass it along, give it to the next generation. You can see that the transfer taxes back at that time, the estate tax, the highest rate of the estate tax was 55%. For a New Jersey resident, there was a 16% estate tax rate, versus if the property was sold long-term, the seller would recognize gain at 20%, income at the state level at 10.75, or even if it's held for short-term, pay 39.6% at the top federal rate plus a 10.75 at the state rate. So you can see that the delta, especially for, most business owners hold on to their business for more than 1 year, which is the crossover between long-term and short-term. The delta between the transfer tax that would be paid by a decedent versus the long-term capital gains rate, it was a no-brainer. Get it out of the estate first. Pass it down. Don't let it be part of the estate. And then came along the American Taxpayer Relief Act of 2012. In this act, the estate and the gift and the GST, the generation skipping transfer tax, were all unified. It increased the applicable exclusion amount, the amount that can pass free of federal estate tax, to 5.49 million. Sorry, this is that should be 5.49 million index from 2011, not in 2017. 40% maximum rate. We added portability, which means that for spouses, if one spouse had unused exemption when they died, the surviving spouse can transfer over or port over the unused exemption that the deceased spouse had, and there's no sunset provision. That was a great change in the estate tax law. So now you can see, again, going back to the New Jersey resident here, the transfer taxes, you had at the federal level 40%, a 16% state estate tax. Back at that time, there was the estate tax in New Jersey. The long-term capital gains rate, again, for New Jersey was 20% for federal, depending upon the involvement of the owner or the seller, a 3.8% net investment income tax plus the state income tax rate. And then for short-term capital gains, you can see that the combined state and federal taxes almost mirrored the transfer tax. So the differences became a little bit less. And so the decision as to whether or not to hold it and take the step-up basis or sell it and incur the tax at the income tax level became less of an issue. And then we had the Tax Cuts and Jobs Act from 2017. This increased the exemption amount to $10 million adjusted for inflation, which currently is $12.92 million, increasing next year to $13.61 million. But, as Steve pointed out at the beginning of our program, this is going to go away. This Tax Cuts and Jobs Act expires on January 1, 2026. So when the clock turns midnight in 1 second, these provisions are no longer available to us. So now I've provided here sort of a side-by-side comparison between New Jersey residents and New York residents, because I think a lot of us have clients who are in New York as well as New Jersey. And you can see that the difference is, at least from the New Jersey perspective, New Jersey no longer has an estate tax. I'm assuming that the seller in this case is passing everything to either a spouse or to a descendant, so there would be no New Jersey inheritance tax either. The long-term capital gain that the seller would have to incur between federal and state would be almost identical to the amount of the transfer tax at the federal level that the seller would have to incur. And if it's a short-term asset, the tax that they would have to pay would exceed even the transfer tax rate. The New York resident, it's a little bit different. You have a New York State estate tax at a high rate of 16%. So there is still a delta between long-term capital gains versus the transfer tax, but less so when it comes to the short-term capital gains. And if you factor in that the seller may be a New York City resident, there's an additional tax on top of that. So the considerations when we talk to our clients about selling a business, it's not just about taxation, especially at this point. Because as you can see, at least for our New Jersey clients, the difference is going to be, this is the current taxation structure for the next couple of years. Going back to what the tax result will be, again, it's going to be not as relevant, not as drastic as it was prior to the 2012 Act. So I think when we look at the intersection between the state and income tax, it's not always just a factor of dollars and cents. It's not just always a factor of whether or not whether or not we pay the income tax or the estate tax. There's a factor of the personal level, the family involvement, the dynamics involved there. But there's more consideration now whether or not we allow for the step-up in basis to pass to the next generation, or we incur the estate tax, or we incur the income tax on the sale. Just a quick scenario for the two of you, my esteemed colleagues. So here's a small fact pattern. A is the owner of an outstanding, A is the owner of all outstanding shares of stock of XYZ Corp. It's a New Jersey corporation. It's elected to be taxed as an S Corp. A is 81. He's got 2 sons that work in the business. A's wife, who was a shareholder, died 3 years ago and left her shares in XYZ to A. A has been thinking about retiring, has been contemplating whether or not to pass the business to his sons or sell the business. He doesn't necessarily believe in handing over everything to his kids. He wants them to work for it, but he's mindful of financial consequences. Steve, Marty, what do you think?
So you mentioned the basis question. One of the concerns you have to take into consideration is if he makes a gift of the business during lifetime, the kids are going to own the asset with a historic basis, and when they sell it, they're going to recognize the gain. So at best, you'll get a deferral. If he were to hold on to the asset until death, the basis is stepped up to fair market value. And for that reason, if a sale is contemplated, based on health, age, and what have you, it may make sense to hold the business to enjoy the step-up in basis and eliminate the capital gain. The problem with doing that is presumably the business value will increase over that time, thereby potentially increasing the estate tax liability. If the business value is under his exemption amount, that would not probably be a problem, and it would probably be worthwhile to hold on to eliminate the gain on the sale.
You could also consider an installment sale to the children. You can then sell the shares, take back the promissory note. Children get a step up in basis because they're paying fair value for the stock. He has capital gain on the sale of his stock. Another option is considering ESOP, employee stock ownership plan. You mentioned that this was an S Corp. We had an interesting case a couple of years ago. We had that situation, and we had the company convert to a C Corp. Why? Because there's a section in Code 1024 that says if the stockholder sells more than 30% of the stock to an ESOP, they get tax deferral, and they don't have to report the gain until they buy what's called replacement securities. Okay, so the game plan was, with this, in my case, that we sold the stock to the ESOP, deferred the gain, and because in this case the woman was quite elderly, she held the replacement securities until she died. We got a step up in basis, and we eliminated the tax on about $8 million of potential gain.
Thank you. And then one final question, Marty. Section 1202 refers to the exclusion of gain on the sale of qualified small business stocks. What is qualified small business stock, and how can the seller of a business take advantage of 1202 to exclude any of the gain from the sale of the business?
1202 is a very interesting section in the code. It says that if you're a C Corp and you've held the stock since inception for at least 5 years, you get to exclude 100% of the gain. So as an example, if I purchase I put in $100,000 into my C Corp to start my widget company, and I sell it 6 years later for $1,100,000, I have $1 million gain. That $1 million gain is untaxed, zero. And it's perfectly legal.
What are some of the other requirements of it, other than being a C Corp and holding it 5 years? Are there?
There's a limit on the total 50 million, is the maximum you can go. I don't know.
Okay. Great. So I think, looking at this, after this discussion and the answers that Steve and Marty have given to us, I think it's pretty clear that the answer is, do we sell, do we hold it, for the next generation and pass it through the estate? I think the answer is definitely maybe. Again, as most lawyers, I'll give the lawyer's answer. it's a case-by-case analysis. It really does require a facts determination to make the decision or help the clients make the decision. Is it better to sell or is it better to hold it and pass it along? Thank you.
And you have to hire us to find out. Thank you, Jason, very much.